Hey, welcome everybody to the 40 Finance channel. Checking in here with a live stream today on what is becoming sort of a down day for stocks, sort of a mildly depressing day in the sense that we got some good news in the job sector. If you're rooting for people to be out of work, that is, which it appears, when it comes to the stock market, people want these employment numbers to go way down. We got the start of that today, but here we are in the afternoon and stocks are still struggling to keep their head above water. So you see the big headline on Seeking Alpha, sort of their afternoon synopsis, if you will. NASDAQ Dow fall more than 1% each. S&P breaches key support levels. Excuse me. So let's dig into that for a second, then we'll look at our own benchmarks here. After an initial bump caused by an unexpected jump in jobless claims, again, this should be negative news, right, for America, but it's actually something that's being cheered for on Wall Street. After that appeared to fade early in the day ahead of the highly anticipated non-farm payrolls report, which comes out tomorrow. Market participants also digested Joe Biden's taxation-heavy proposed budget. Into the final hour of trading, NASDAQ was down 1.62%, Dow retreated 1.35%, S&P slipped 1.5%. All 11 S&P sectors are now trading in the red, led by more than a 3% fall in financials. The financials are really weird. It's not something that I own any investments in, but with interest rates higher, you would just figure that they would make more money. And with some of the debt and job problems that we have going on, you would figure that loan originators would be making more money in this environment. But for some reason, financials have been a dog for a while now. Let's see, on Thursday, the number of Americans filing for initial jobless claims the past week rose more than the anticipated 211,000 versus the consensus number of 195. It was the first time the figure crossed the 200,000 mark since January. Really not, it's a weekly number, but, since January, that doesn't feel like it made a huge impact there. Market participants took heart from the data earlier in the day as it pointed to a cooling labor market, an area which the Fed is paying close attention to in determining rate hikes. All right, Treasury yields were lower on Thursday. The 10-year Treasury yield dipped 6 basis points to 3.92%. 2-year fell 17 basis points to 4.9%. So right there, you've kind of got two good signals that would suggest maybe the market should be going up, but that's not the case. Among active stocks, SVB Financial cratered more than 40% and was the top percentage loser. U.S. listed shares of JD.com, which is a Chinese stock, slipped despite a quarterly results beat as investors were disappointed with its slowdown in revenue. All right, so that's kind of the high level of where we're at today. The factors that are supposedly influencing the market. And they talked a little bit about this S&P breaches key support levels. And I want to look at that for a second. There's a lot of different support levels that are out there. We're going to go to the SPY and look at some of them that they chart in Seeking Alpha. By the way, if you're interested in learning more about Seeking Alpha Premium, my affiliate link is in the description. Gets you a great discount, $99 for the entire year. Potentially support my channel as well. So check that out if you're interested. It looks like the SPY is closing in on minus 2% if this trend keeps up. And if we go down to our key moving averages, all right, here's the levels that we're looking at least when it comes to simple moving average. You have a 200-day of 393. Right now, we're plus 1.45% above that. So really riding the line on the 200-day, and it's about the same on the 100-day as well. So one of the things that you're going to hear come up if we get to this is 391. What did I say that number was? Oh, we might have actually dipped below it, because this moving average table is based, I think, on the closing price the day before. So we are officially below the 200-day simple moving average, which is not good news, obviously. And there's a lot of folks that look at that religiously as a trend setter. So if my math is correct, we dipped below that here today. Let's look at the QQQ, 292.60. It is also 1.75% down. Let's take a look at its 200-day. It's 290.09, okay? So the QQQ has been up a little bit more than the S&P this year as tech stocks made somewhat of a rebound. But you got about $2 in here before this starts that trend into the wrong direction on the 200-day. So all those things in mind, it's getting harder and harder to, I would say, withstand some of these negative days. And the Bears are winning. The Bears are winning this week. How long will it last? It's very hard to say, but one thing's for sure. The Fed didn't do us any favors if you're rooting for the upside. And it just really feels like this has to play out for probably a couple months, at least. And that assumes that the data starts to trend in the right direction. So it's a tough time, especially for someone like me who's generally bullish, particularly on the QQQ. But it's not, the problems are still short term, okay? And that's what you have to remember. It feels like a heavy load, and very well may be that the Fed does increase interest rates 2 or 3 more times, but it is a short-term problem. 2 or 3 times does not cover the year. All right, there's at some point the switch is going to flip. Hopefully, we all have some jobs left afterwards. The way things are going, but you got to keep your eye on the prize. Hey, Kevin, good to see you. All right, let's take a look at who is winning in this atmosphere. All right, so this is a stock screener I created. It's just large and mega cap stocks here in the United States, about 774 of them. And what I sorted by here was, and I don't know if you can read that very well, this is EPS revisions. Okay, so we know we just had a huge block of earnings. Who did well in those earnings? And by doing well, it means who at least showed enough promise that they got EPS revisions to the upside. All right, so these are arguably the companies that showed the most promise coming out of most recent earnings. You have Aflac. All right, let's take a look at Aflac. So obviously, this is an insurance company. It's down 1.75, but let's look at their earnings. They reported on February 1st. They actually had a miss. On the GAAP side, they had a miss, and they were down on revenue. However, when they did announce their guidance, you can see that they had an upward swing as far as analyst revisions go. So there must have been some good news in there. I don't know what it was off the top of my head. But you now have GAAP estimate of $1.38 and 10 analysts say, going up on the estimates that they've given. Now, if that holds true, that would be for Q1. It would come in late April. And here we are in Q1. If they hit this $1.40, we compare that to last year, they were at $1.37. All right, so it's a 3% gain. It looks like that there's more opportunity potentially in fiscal quarter 2 and 3, certainly compared to what they did last year. So good news for them. On the revenue side, let me see if we can get that here. All right, on the revenue side, though, you get this. All right, if they hit the estimate as of now, 18.54 billion minus 5% on the year. So you have EPS, if they get to 567, that's a single digit increase year over year, but revenue is down. And this is going to be, I think, a fairly common story for the companies that do well this year. All right, so the ones, and not a lot of people are talking about this, but there's a lot of opportunity for any company, but in particular large caps, I would say, to lower their expenses to boost revenues. All right. Now, the problem, if you like tech stocks and QQQ and things like I do, is a lot of their expectations are tied to revenue and users and certain amounts of growth. But even a Google, Netflix, take your pick, they can manipulate this game on the EPS side to produce, to live up to their valuation expectations. So that is sort of a secret weapon. We'll see how it comes out. Aflac can pull this off because nobody really cares about their revenue, right? They're invested in this one to see profits. This might even be a dividend stock. Yeah, dividend rate going forward, but $1.68. So if you're an Aflac, you're looking at this dividend, it's a little bit less pressure for them to generate more revenue. Let's take a look at another company here, John Deere. They had a good first quarter and a good outlook. You see their fiscal period would end in October of 2023. So, everyone else's third quarter, they're going to be done with the year. They are showing right now the pace for a 25% EPS growth. All right, after the most recent quarter, these are the updated analysts, or updated estimates. Now, revenue, double digits again. So that's a much different story than Aflac. This is the kind of story that just makes for a great stock market or great individual stock outlook, right? You've got double digits, top and bottom line. I don't know enough about the John Deere earnings report to say why this is happening or what has them excited, but this is definitely an example of finding a potential winner buried in all the negative news. Let's see if we can, let me see here. Okay, yeah, I was going to take a look. I do this a lot. I think it's always interesting. I take a look at the valuation metrics versus the 5-year average for a particular stock. So in John Deere's case, let's go to forward, 13.9 forward PE based on the revised analysis. That's minus 25% off of what they normally do. And so that's a 18.73 is their 5-year average. So yeah, that probably includes some inflated numbers during COVID. It also includes some normal time numbers, right? You're going back 5 years, so you're going back to 2018 or so. All right, so you put that average together, it's at 1873. Right now, they're at 1390. So this could be an interesting stock to look at. How about revenue? Revenue growth going forward on this chart, or this table, it's projected at 12.03. That is above the 5-year average for John Deere. So again, there's a lot of positive signals here with a company like John Deere. It's not enough to just look at these. You've got to read why things are happening and what the longer term outlook is. But just to pick a stock that is, on strong momentum right now, it's showing a lot of positivity. I do believe Deere, I'm guessing, has a dividend. Yep, yield of 1.18%. Comes out on Seeking Alpha's estimate to be $5 for the year. So very interesting. John Deere. Who else do we have here? How about Berkshire Hathaway? This is the B shares. And for whatever reason, their earnings, they don't have much of a revision Only one analyst did it, so I'm going to skip it. I was wondering because with Berkshire, it's very hard to calculate their earnings because they're a conglomerate of smaller businesses. How about Hershey? You know, if the economy is going in the tank, you might as well enjoy some chocolate. And let's see what they did. So they had a green, on February 1st, they had a green latest quarter earnings, beat across the board. Mixed bag, though, on analyst adjustments. You've got eight analysts, you know, adjusting upwards, 5 going downwards. Let's take a look at how that stacks up valuation-wise. So PE non-GAAP forward. Actually, let's do PE GAAP forward. 26, based on the most recent updates. Not a discount deal necessarily. It's 10% higher than the 5-year average. What about sales? 4.36, that's a little bit higher. So Hershey, I don't know, doesn't really scream huge deal. Revenue growth looking forward about 9%. That is higher than their 5-year average. So for whatever reason, they are projecting better growth than they've seen in the past. It's just not my kind of stock, to be honest with you. But it could be one to look at if you're looking for one who's got some earnings momentum of late. 1.73% yield on Hershey. Let me try to pick out another one that maybe I recognize. United Rentals is interesting. You know, typically with United Rentals, you're looking for construction boom periods, very similar to what we had, you know, perhaps during COVID. And you're talking about big rental items here. We're not talking about like a chainsaw. You know, you're talking about like huge forklifts, things like that. Let's see how they performed. Sort of a negative last quarter earnings. You missed on GAAP actual by 44 cents, but revenue surprise was plus $1 billion. Now coming out of that quarter, whatever they listed on there, you had EPS revisions. 11 analysts adjusted to the upside on EPS revisions. And so over the last 90 days, you have 20 on the upside. Let's see what we've got. On the growth for United Rentals, revenue growth looking forward, 14.5%, 5-year average is single digits. So that's very encouraging. Where are we at on valuation? PE gap forward of 12, 5-year average 12.79, so right in line with what they've done over the past 5 years, but with the caveat that revenue, you know, significantly above the 5-year trend line. So United Rentals might be worth looking at. I would say with this one, at least my familiarity with it, they have a strong track record as a stock. And if you're not familiar with it, it's a very interesting industry, you know, where they basically rent huge construction type equipment, anything you can really imagine, to businesses, but not always just for like the one day, right? And not just like you in your backyard renting something like a hole digger or something to put in a fence. Like they're renting to commercial companies almost like a lease for like a year. You know what I mean? And then they have a whole auction system on the back end on how they get rid of it. So it's an interesting company. If you're bored one day, you can go on a rabbit hole on that one. All right, here's one. How about Booking Holdings? So a lot of, I would just say, uncertainty with travel stocks. I think the market is still trying to figure out which way travel stocks are going to go this year. You know, it was a pretty common hypothesis last year that everybody's going to get out. COVID's over. There's extra money. There was sort of a shoo-in that travel would explode. This year, perhaps not as much, but there's one exception. And that is, of course, China lifting travel restrictions, and in general, some of the other countries that were withholding, people from traveling out of country and making it harder to get places, that's sort of been unlocked. And if you know anything about travel, you know that foreign travelers, whether you're in the United States, China, France, wherever, folks who go to another country are the most lucrative of travelers, right? Because they typically have long flights, there's currency exchange. Quite honestly, they pay out the wazoo because they're going to a foreign land. So they want to make sure when they get there and know what the hell they're doing. So they're getting tour guides and all these things. That's going to happen this summer. Is it enough to offset the boom times of domestic travel last year? That's above my pay grade. But let's take a look at what we saw with Booking Holdings. Huge quarter. This was on February 23. They beat basically by 10% on the EPS line. And actually, the GAAP actual beat by even more, 30% or so. And they beat on revenue by 150 million. Whatever they said in terms of guidance, it has led to 11 upside revisions and two to the downside. So let's take a look. We'll start with growth, then we'll get into valuation. Revenue growth projected 26.64% for Booking Holdings. 5-year average, 100% more than the 5-year average, which is 12%. So that's a very strong number, obviously. But I think it's particularly strong versus the 5-year average when you think about what last year was. Booking Holdings, maybe they are more prone to those international travelers, which has led to this opportunity here. Now, if we go to valuation, where do we sit looking ahead? So PE gap forward, 20.76. Looks like they're missing some data on the 5-year average for this one. We can look at non-GAAP, which is 19.85, 57% off of the 5-year average. So just kind of clicking through these handful of stocks here really quickly. Here's this PEG non-GAAP forward of 1 versus 2.31 on the 5-year. It's minus 56%. I'd say John Deere and Booking, on me just picking random stocks, are definitely worth looking into if you're looking for stocks that maybe have a more positive momentum in this, let's just call it, stressed environment. All right, let's finish up and look at QQQ. Sancho says hi, says buy, buy, buy. He's buying hand over fist. And I think if you're a long-term investor in these unsettled times, you really have to think about it. I mean, you really have to think about closing your eyes and buying quality companies for the long term, because you just don't know when this light switch is going to flip to the other side. I don't think it's tomorrow. Okay, I don't think it's April, maybe not even by Memorial Day. But eventually, Jerome Powell's going to go away. All right, eventually we'll get to some sort of commonality between bulls and bears, that we've lost enough jobs, that the CPI reports are normalizing. We'll get there eventually. So this is the time to add a share here and there best you can, going through. And that's all I'm doing. And right now it's only QQQ that I'm buying, but it's literally a share at a time. Because I just don't know which way this thing's going to go, but I do believe in the long term, and you have an opportunity to set yourself up for some impressive returns. How about in a year? Would you like to have more money next year than you have today? In my opinion, it seems likely that the stock market will be in a better place, more certain place anyway, next year than it is this year. And if you watch the channel, you know that I'm banking on that probably happening no later than Q3, Q4. So I think you'll see the rewards by the end of the year. At least for myself, that's what I'm aiming for. All right, on the QQQ side, if we go to, can I do it this way? All right, we can do it this way. It's a little slightly different look, but who has won EPS revisions after Q1, specifically within the QQQ? So I made the stock screener in Seeking Alpha, represents, it's roughly 70% of the QQQ, and it's got all the top names in there. Cisco gets an A+ for their revisions. Let's take a look at what Cisco might be doing. All right, last quarter, they beat by 179 million. They did miss by a penny on EPS gap, but check this out. 23 analysts revising to the upside on their annual EPS numbers, which is very, very strong. And if we check out what that means for our gap PE, they're not going to give it to us on 5-year. How about non-gap PE forward, 1308? Not a huge discount to the 5-year average, but minus 13%. It's still under the 5-year average, so that's a positive. And then growth, not as strong. Oh, that's EBITDA growth. Revenue growth, 5.65%. Cisco doesn't grow, say, like a Tesla or whatever. But this 5.65% is higher than the 5-year average, 2.26%. So even though you see this sector relative grade of D+, that's compared to the whole sector, which, you know, they're in information technology. So 5% isn't going to turn many heads in information technology, but when you pin it against Cisco's standalone averages, it's a good year that they're looking at here. It's a good year, 5.65, and valuation being a couple points down from average. Cisco's, I'd say it's looking okay. It's not a stock that intrigues me, but keep in mind it's an old school tech stock, so you do get a dividend rate. Looks like 3.18%, at least according to Seeking Alpha. All right, PayPal. So one small piece of good news I got this year, even though it hasn't translated into the stock price, is PayPal's earnings were very strong. The guidance was very strong, and depending on what you think of Dan Schultman, he's retiring. There's a lot of folks, including me, who think that that's probably good news, just because PayPal has been very stagnant ever since their all-time highs, which I think were close to $300. But let's get down to the brass tacks and see earnings. All right, so the revenue was off, and EPS gap actual minus 3%. So seems negative except for their guidance looking ahead through this year. All right, and with that guidance, which I thought, this is totally off the top of my head, but I thought it was like $4.75 a share. We'll check it in a second. But it did lead to 17 upside revisions versus 6 to the downside. Let me see if I can get this number for you. All right, EPS estimate 488. I think their guidance called for 4.75, but they also said that that was a very solid estimate with potential room to the upside. So that's 18% growth in EPS, which is good news because I'm a PayPal bag holder, and they're going to need more EPS than that to get me out of my hole, but it's at least a step in the right direction. Now, on the revenue side, though, you know, not double-digit growth on revenue. Hopefully they outperform, but they're making, you know, the right strides in profitability. Now, how does that stack up? I have a feeling, yeah, on the growth side, 8.36% is well below the 5-year average, 17.28. So that's going to be a thorn in their side, depending on how it actually materializes as the year goes on. But on the earnings side, if you just wanted to get into straight profitability, P non-gap forward of 15, 59% cheaper. Okay, so 59% cheaper from a PE multiple. The growth, though, is 51% less. So that's the drama, right? And that's why I can't say with too much conviction that PayPal, has free reign from here. I think they get over $100 this year. Certainly once the market shakes out, and if they could get to $5 a share on the EPS line, I think that's good. But this is a classic tale that you're going to see here when you're going to need your earnings line to go up significantly for your favorite stocks, right? You're going to need your non-GAAP, depending on what you report in. PayPal is always non-GAAP, so 15 here is better than perhaps what you got in the past if you're buying it today, but that growth rate's going to be a stickler. So the only way you can improve those situations is over-index on your earnings, right? So instead of $4.88, if you do outperform and you get to 5.25 or 5.3 on the earnings scale, then you might still have this paltry multiple, or maybe it goes to 20 or something. But then all of a sudden, you're eking your share price over 100. We'll see how it goes. It seems like, for me personally, it's going to be a long road to dig out of the mistakes I made with PayPal. All right, guys. That's a look at what's going on today. Final check of the numbers. Let's go to Seeking Alpha homepage. Did we hit 4 o'clock yet? Yeah, we're at 404, minus 2%. Let's see who had a big day on our way out here. That's top rated. Here we go. This is the day watch section of Seeking Alpha Premium. Top gainers were Intuitive Machines, Build-A-Bear, KLX Energy, and Asana. Most active shares, Tesla, Bank of America, Ford Motor, and Amazon. Bitcoin, just caught this out of the side of corner of my eye, minus 8%. FANG 5, Tech 5, all down 1.5% to 2%. And your losers of the day, SVP, which I believe that's the one that was involved in some sort of crypto thing I saw, Fulcrum Therapeutics, PacWest, R House, names I'm not super familiar with. Larry's here. Are you still buying the Qs? Absolutely, yes. Okay. And I just talked about that a little bit if you got here late. It's slow and steady. Okay. It's not an all. I was much more all in last year, and that proved to be, honestly, I was impatient. But the way that I've dollar cost average, it's really not that bad. I mean, on the Qs anyway, I think I'm in a minus 10 to 15% range on my holdings. So I expect that world to get better. I don't necessarily expect it to get better tomorrow, but I do think that the headwinds that we have right now eventually do go away. Might be fall, might be winter. Either way, I'll continue to add to my position. And Larry bought QQM. Larry, I'm glad you said that, because I am going to do a video on QQM probably next week. And it's basically, it's just another way to invest in the QQQ. And it's got some attractive features if you're holding it for long. Okay? So the only negative side to it is if you're trying to get into options, which isn't that's eventually something I'm going to do with the Qs, then it doesn't have as attractive as option contracts, but you also save on the expense fee. Much better suited for a long-term hold. So good call out there, Larry. All right, guys. Don't forget to check out that Seeking Alpha special offer if you're interested, down in the description. Thanks everybody for showing up for this live stream. We'll see you on the next video.